Welcome to the deep dive. Today, we're going to try and put aside all the headline noise, all the punditry. Our mission is to really understand the institutional grade playbook. I mean, how do you senior portfolio managers actually analyze market structure in the S&P and NASDAQ?
Right, we're looking for the blueprints, not the tea leaves.
Exactly. And we're going granular, pulling from a recent structural analysis that focuses on 4 key pillars: liquidity, volatility, correlation, and of course, institutional flow.
And that institutional view is, well, it's everything. Especially right now, when the market sentiment is just stuck in that neutral zone, the headlines are basically useless.
So the real story is in the details.
The real story, the conviction, it's only visible in the microstructure. We're hunting for those little factors that reveal hidden intent or, structural fragility.
Okay, let's unpack this. Let's start with where institutions look first. The flow, specifically the close. Why is that final hour of trading so critical?
Well, the close is where the real money prints. It's when the big institutions execute block trades that would just be too disruptive earlier in the day.
Okay, so they're looking at things like order book dynamics.
Entirely. They're watching the bid-ask spreads and the big components, think SPY, QQQ. If those spreads are widening into the close, that's a huge warning sign.
So a wider spread isn't just about cost, it's a signal of thinning liquidity.
Exactly. It means the market's getting brittle. A big order is going to have a much bigger price impact, more slippage.
And it's not just the spread, it's the depth too, right?
Oh, absolutely. We look at the order book depth level 2, level 3 data. Is it collapsing in that last hour? If you see bids and offers suddenly get pulled,
It means the market makers are stepping back.
they're stepping back. It signals uncertainty, or maybe something more strategic, that the book is being cleared for a big pre-planned print.
You mentioned block trades, which brings up segmented volume. Most retail traders just see the total volume on the ticker.
Right, but that's not the whole picture. You have to segment the volume. What's going through the lit exchanges versus what's moving through dark pools.
And dark pools are essentially private exchanges for institutions.
Private trading venues, exactly. So a late surge in dark pool volume matched with a clear price direction that suggests strategic accumulation or distribution happening off-book. It's the smart money trying to hide its tracks.
And that's how institutions can really define accumulation versus distribution. It's not just if the market closed green or red.
No, not at all. Accumulation is a strong upward move in that final hour on significantly above average volume. That's aggressive buying conviction.
And distribution is the inverse.
The inverse, a downward move on heavy volume. Institutions are actively hitting any bids they can find on the way down.
So what's the final check? How do they confirm if that move was real? I assume something like VWAP comes into play.
VWAP is the ultimate confirmation tool, the volume-weighted average price. It's the true average price for the day, weighted by volume.
And the rule is simple.
Vary. If the close is significantly above the day's VWAP, especially on heavy volume, that confirms successful institutional accumulation. They paid up. A close below VWAP confirms distribution. It is the clearest signal of commitment.
Okay, this is where it gets really interesting for me. Let's move from flow to what people are paying to protect against that flow. Volatility. Most people just glance at the VIX number.
The fear gauge, right. But that's just one piece.
The term structure tells the real story.
Yeah.
What is that? What does it give us that the headline VIX number misses?
The VIX itself is just a 30-day snapshot. The VIX futures term structure, on the other hand, it's the market's forward expectation of volatility. It's a map of anticipated fear over time.
And in a healthy, quote-unquote, normal market, what does that map look like?
Normally, it's in what we call contango.
Contango.
It's an upward sloping curve. Futures contracts that are further out in time are priced higher. It just means the market expects today's low volatility to eventually revert back to a higher long-term average. It's calm now, but storms are always possible.
But the real alarm bell, the thing that makes PMs sit up and take notice, is when that curve inverts.
That's backwardation. And yes, it's the big one. An inverted downward sloping curve. Near-term futures are suddenly more expensive than long-term ones.
Meaning the market is in an active panic?
Active panic, it signals acute, immediate stress. There's a massive urgent demand for short-term hedging. It's rare, it's usually short-lived, and it tells you people are bracing for impact right now.
So if our sources are saying market sentiment is neutral, but you start to see that curve flatten or even hint at backwardation, what does that tell you?
It tells you the institutional players are completely ignoring the headline. They are buying protection, and they're doing it aggressively. They see something coming that hasn't materialized yet. It's a massive contrarian signal.
And I guess you can see that in the implied volatility skew as well. That confirms the intent, right?
It's the smoking gun. FOVI skew is just the price of insurance. It measures the difference in implied volatility between at-the-money options and out-of-the-money options.
So if everyone starts buying downside protection,
Then the IV, for those out of the money, shoots up. The downside skew rises. It means institutions are willing to pay a huge premium for the right to sell at lower prices.
they're buying crash insurance.
Powerful, cheap insurance. And you can see the opposite, too. If OTM calls IV spikes, it signals aggressive speculation for a big breakout to the upside. The skew tells you where people are willing to pay up.
All right, let's pivot to the broader health of the market structure. Is the rally built on a strong foundation or on sand? What did the recent data, say around early December, show about breadth?
This is where we saw a classic conflict in the data. On December 1st, breadth looked fantastic. The advanced decline ratio was 1.66, and for large caps, it was a really robust 5.3.
So a broad, healthy rally, lots of participation.
A very strong foundation. But then you look at the very next day, December 2nd, and the structure started to wobble, even as the S&P eked out a small gain.
And that's the tell.
That's the key structural warning. On the 2nd, the internals tilted negative 216 advancers versus 286 decliners. The caution here is huge. When the index rises, but fewer and fewer stocks are participating.
It means the mega caps are doing all the work.
All the heavy lifting. And that makes the rally incredibly vulnerable. It masks all this underlying weakness and creates a huge concentration risk.
Speaking of structural fragility, let's talk about correlation breakdowns. This feels like the biggest structural shift for risk managers in years.
Oh, it is. The death of the golden parameter.
The 60-40 portfolio.
Exactly. The whole playbook was built on the idea that equities and bonds have a negative correlation. When stocks fall, bonds rise, and that cushions your portfolio. That was the shock absorber for decades.
But the data shows that relationship just broke, especially in 2022 and 2023. What was the number?
The correlation didn't just go to zero. It jumped deep into positive territory. It hit 0.58.
Wow. 0.58.
I mean, think about that. Decades of risk models were built, assuming these things moved inversely. When the correlation turns positive, stocks and bonds fall together. Your diversification just vanishes right when you need it most.
So every PM on the planet was forced to completely rethink their risk management. They had to find new, more complex hedges.
Precisely. And that kind of structural shift, where the market shock absorbers fail, it often precedes much bigger systemic moves. The cushion is just gone.
Which brings us to the market plumbing, the underlying systemic liquidity, the financial system's safety buffer. What are the sources saying about the short-term funding markets?
We have to look at the repo market. It's where all the institutions borrow and lend overnight. And on December 2nd, U.S. banks tapped the Fed's standing repo facility, the SRF, for $26 billion.
Okay, let's define that for a second. The SRF, what is that exactly? Is it like an emergency ATM for banks?
That's the perfect way to put it. It's the banking system's emergency backstop for short-term cash. And $26 billion is a huge number. It's the second highest usage since the 2020 crisis.
So it's not a full-blown panic, but
it is smoke coming from the engine room. It's a massive indicator of rising funding pressure. There's thinning liquidity in the money markets.
And this isn't an accident. There are structural forces at play, right? Two big ones.
Right. First, you have the Fed's quantitative tightening, QT, which is actively pulling liquidity out of the system. Second, you have this continuous massive issuance of new Treasury debt.
So more demand for collateral, but less cash to pay for it.
You got it. That combination is squeezing the system's safety margin.
And if we tie that back to the market, what's the consequence of operating with a thinner safety margin?
The consequence is that the market becomes far more susceptible to shocks. With constrained liquidity, if a sudden sell-off hits, the price move will be disproportionately violent because there aren't enough bids ready to absorb that selling pressure.
So it increases the probability of a huge overreaction.
A massive overreaction.
Okay, so we've got fragile breadth, broken correlations, tight liquidity. Now for the payoff. How do senior PMs use all this to find asymmetric risk-reward setups, finding that convexity?
They hunt for dislocations, places where market expectations are totally misaligned with the underlying mechanics. Specifically, they're looking at options gamma exposure.
This is where the dealers who sell the options stop dampening moves and actually start accelerating them.
That's exactly it. When dealers are short gamma, they have to hedge dynamically. If the market rips higher, they're forced to buy futures to hedge. That buying makes the market go even higher.
It pours fuel on the fire.
It accelerates the rally. And if the market falls, they're forced to sell futures, which accelerates the move down. They become momentum chasers instead of liquidity providers.
And that transition from dampener to accelerator happens at specific price points, the gamma flip levels.
Those are the critical levels. A gamma flip is the price where the market's aggregate auctions position switches from positive gamma, where dealers suppress volatility, to negative gamma.
So on the upside, you're looking for call walls.
Major call walls. If the price breaks above a big call wall, it triggers that forced dealer buying, creating an accelerated squeeze higher. That's your low-risk, high-reward upside convexity.
A self-fulfilling prophecy created by mechanics. So where does the underpriced tail risk hide on the downside?
That's near the put walls. If the market breaks below a major put wall, it forces dealers into that aggressive mechanical selling. It turns a small dip into a violent self-feeding correction.
And the asymmetry comes from finding a big put wall just below the current price where the protection is still cheap.
Exactly. Protection is cheap because sentiment is neutral, but the structural consequence of breaking that level is absolutely massive.
So the thesis is clear. Asymmetric opportunities, they don't come from guessing headlines. They come from finding where embedded expectations in options in order books are misaligned with the potential for an accelerated move.
It's the difference between being a speculator and a structural mechanic. If you know the exact price where dealers are forced to chase the market, you know exactly where the risk-reward profile changes dramatically.
Let's recap this playbook for everyone listening. We've confirmed accumulation is defined by above-average volume and a close above the day's VWAP, especially in that last hour.
And we established that the VIX term structure, especially a move toward backwardation, is the true gauge of institutional stress, no matter what the headlines say.
We also noted that huge systemic risk from the equity-bond correlation breaking, hitting 0.58. That forced a total rewrite of risk management.
And finally, that critical warning signal from the repo market. $26 billion in SRF usage shows liquidity is tightening structurally, making the whole system more fragile.
So despite any surface-level calm, the analysis reveals a system under strain, tighter liquidity, challenge diversification. It demands vigilance.
Right. Understanding the mechanics that amplify a move is far more valuable than trying to predict the trigger for the move itself.
Okay, a final provocative thought for you to chew on. Let's say the VIX term structure flattens significantly next week, moving sharply away from any hint of backwardation. How would you reevaluate the risk posed by that strain in systemic liquidity, that elevated $26 billion SRF usage? Does greater complacency in the options market make a liquidity shock more or less dangerous? Something to consider as you build out your own structural map.